Hey guys, how's it going? Hope everything is going well this weekend. And what I did last month was I did a video on a potential dollar reversal. And my reasoning was number one, you saw huge positioning in the commercial traders. They were going long bonds, while at that time the dollar was rallying. And when you saw the sell off of bonds during that time, a lot of people are saying, hey, you know what? This is good for the dollar. And what I said was, okay, let's look at this. You see a lot of people buying bonds, and because of the interest rate differential, what would happen after the Fed raised rates, you would see a reversal in the dollar. You would see a rally to bonds, counter trend rally. I do feel that the bond market's going to sell off, but that's going to take some time. It's not going to happen all at once. And right now, month after we've done that video, you've seen the dollar sell off just a little bit, not so much, but the bonds have rallied if you look at that. Now, I want to look at Zero Hedge. This article is really interesting. It says treasury shorts or treasury speculators are so short, it is now a 4 sigma event. Sigma means standard deviation. So I want to look at that carefully. Speculators, like hedge funds, money managers, retailers, if you look at this, the everyone's saying that they want to short bonds. Smart people that I follow are saying I want to short bonds. But you have to look at the fact is a lot of people feel that interest rates are going to go higher. I feel interest rates are going to go higher. Everyone around me says get a house now because interest rates are going to go up. That's what my mom told my wife. She to try to pressure me to get into a house because interest rates are going to go higher. So you see it all around. Everyone feels interest rates are going to go higher. And I want to tell you a story. I met a friend for his birthday party on Friday, and he knew another friend who I met before, but then we're talking about trading because he trades for a living. So then I asked him, how do you trade? He says, I trade based on what I feel. And I was thinking to myself, this is how I've lost a lot of money based on how I feel, not looking at data. And a lot of people are feeling, like I said, shorting bonds. Now, I wanted to look at the positioning of the commercial versus non-commercial money commitment of traders. And just look at this. Let me just hide this open interest. I don't really care about that right now. So the non-commercial money, they have a net short position. This is a 30-year contract. While you could see over here that the commercial side, they have a large long position. And I pulled out the data since 2010 and positioning sizes of the commercials. And you could see in 2010, the commercials were really long bonds, right? This is when I was actually shorting bonds. I got burned. I remember this clearly. My guys, the TBT, TMV, way too early. And you could see, even in 2011, they had a large long position, while the speculators are net short. Like I showed you in that article, it's a 4 standard deviation move or positioning size. All I can say is the commercial monies, they tend to be more right at price extremes rather than non-commercial, the money chasers. So all I'm saying is if you do see the commercial money and with the long position, continue with this long position, and assuming that history proves itself to be right again, they are right on this move, you're going to see, in my opinion, a short squeeze in the bond market. you're going to see the bond market rally to levels that we wouldn't expect it would have moved to. And that's why I bought like the TLT in December, like call options. I've been trading around it, and I bought it again Friday. I sold it Friday and I bought it again on the sell off. And the only reason why I want to do this is because of the positioning size of the commercials. Otherwise, like I told you, I feel like shorting bonds, but the data and the positioning size, it doesn't show it. I know all these hedge fund guys, they look at moving averages, momentum charts, and whatnot, but I don't care about that. I'm simply looking at the commercials versus non-commercials and make my decisions off of that. And then that Zero Hedge article, I think that's just an obvious way of using this information in a contrary manner. Treasury speculators are so short now, it is a 4 standard deviation event. Zero Hedge talking about it, no offense to Zero Hedge, right? And the hedge fund guys, but just the timing's off of these guys, in my opinion. Anyways, guys, let me know what you think. And because of all of this, I feel that the dollar will lose some ground because of the interest rate differential. Right? Bonds initially rally, and since they rally, the euro goes up, dollar goes down, and whatnot. And also, from a fundamental perspective, you have to look at the fact that currency was rallying up into the interest rate hike, the dollar. And when you see interest rate hikes, that usually is bearish for a currency as long as, number one, that interest rate is below the market rate, in which it is. And that's what you saw in the 70s. They raised interest rates, but the dollar actually went down until 1980, where the Fed funds rate was above the market rate. So that's something to know. And 50 basis points is below the inflation rate, what the Federal Reserve has, or whatever it is, 60 basis points, 70 basis points, whatever it is right now. So just keep this in mind. This is where I'm using contrary information, or I'm using information and going against the speculators. I'm going on the side of the hedgers, the smart commercial hedgers, because it looks like an extreme price movement or extreme positioning sizes of these two classes of investors. Anyways, guys, let me know what you think. If you think a dollar will rally or reverse. All right, talk to you later. Bye.